Hello and welcome everyone to our conversation with precious metals experts Nick Barisheff and David Morgan. My name is Chloe Taylor-Blay and I am with Bullion Management Group. Nick is the founder, president, and CEO of Bullion Management Group and author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. And David's a widely recognized analyst in the precious metals industry, publisher of the Morgan Report on Precious Metals, and author of Get the Skinny on Silver and the Silver Manifesto.
Good speaking to you, David.
Thank you, Nick. Thanks for inviting me.
So we have a lot to cover today. So David, why don't we begin with you? Can you give us an overview of the silver market, supply versus demand, and some of the demand drivers?
Certainly. I'll take a fairly long look at the supply-demand situation. If we go back to about 1999 to 2006, we were in about a 16-year deficit in silver, which means that the amount of silver from all demands was greater than the supply from all sources, meaning mining and recycling. There was 100 million ounces a year, and there was an above-ground stockpile at that time of roughly 2 billion ounces. So 16 years of 100 million a year is about 1.5, 1.6 billion ounces. And it took down the stockpile from the 2 billion ounces of 1999 to a level of about 500 million ounces, roughly, in 2006. However, during the year approximately 2000, there was a big boom in commodities that started. And silver, along with all other commodities, specifically the metals more than anything, were on the increase because the demand was so strong coming out of China. So over the years 2000 onward, we had a huge boom in commodities up until roughly the year 2010 or so. And what this means is that there was a continual increase in the base metals, lead, zinc, copper, also the precious metals, silver and gold, platinum, palladium for that matter. And so the supply started to increase. And around 2006, the supply of silver turned into a net positive, not a deficit. So which means, again, that the total amount of supply coming from mining and recycling was greater than the total demand. So stockpiles started to build. So we went from the 500 million around the 2006 area, time-wise, to present day, 2015, where we're back to roughly 2 billion ounces of silver above ground. So there's a bit of confusion about the supply and demand specifics, and I'm trying to keep it very simple. But you hear continually that there is a supply deficit. If and only if you look at mining supply, then you could say unequivocally that there is a deficit year over year because total mining does not meet total demand. However, recycling is at a level, depending on which study you look at, of somewhere between 160 to 200 million ounces a year. And that is a silver supply. So if you add the recycling and the mining, again, from roughly 2006 onward, we've been pretty much in a net supply surplus. And again, you have to look at each specific silver study. The GFMS published by the Silver Institute actually shows a deficit in a few of those years. Using that methodology, if you go to the CPM group, they have a little bit different take on the situation. So deficit for 15 years and now a quote-unquote surplus, and I'm sure Nick will have some questions about that, for the past several.
Well, the interesting thing is when you look at the old inventory, which is the 2 billion ounces, but from what I recall, 1 billion of it was with the mint and 1 billion was it in strategic reserves. And both of those have been depleted. So the question is, I don't think either one has been rebuilt in those two areas. So someone else is holding the current inventory, and it makes for a very vulnerable position for the U.S. The reason you have strategic reserves is because without silver and platinum, you don't go to war because it's needed in all the high-tech electronics and missiles and bombs and everything else. So it's the last thing you want to sell off, but they did.
I'd like to add on to that, Nick. First of all, very, very good points. So if you look at today's holdings, the 2 billion ounces, roughly 1 billion of that is in coin form. This is either government-issued coins like the Canadian Maple Leaf, the U.S. Silver Eagle, the Philharmonic, or silver rounds from private minting. And so that's half of it that's widely dispersed among retail investors primarily. There's some institutional holding of coins, definitely, but primarily, so that's half of the supply. Then you look at the commercial bar inventory, and a great deal of that is held by institutions in the SLV, BMG, your company. There's others like Sprott, PSLV. So if you look at the commercial bar inventory that's held for investment, and you look at what the total leftover is, it's extremely small. So Nick, I again want to add on to that, because you have to look at, why silver is being held, where it's being held, and I'll just again add on. I mean, it was in the strategic stockpile of the United States for a reason. And of course, those reasons are probably more pertinent today than they've ever been, and yet the cupboard is empty for the U.S. government.
Well, exactly, and now, regardless, like the mine supply is precarious, and as most people know, that 75% of the silver comes from byproduct supply, and with commodities taking a hit, like the conventional base metals have gone down. New exploration has gone down. New exploration for silver has gone down. What junior mines were almost ready to go are now out of money, and some of them are shutting down or being sold at fire sale prices. So when the price of silver rises, it's going to be a fairly significant gap in terms of when new production will be brought on stream. In the near future, it's usually 5 to 7 years to bring a mine on to production. So you're going to have a big gap in supply.
Exactly. I mean, the dynamics in the commodity cycle overall is, not that difficult to explain. You usually go from an undersupply situation, a commodities boom driven for whatever reason, a lot of companies come into the fore and start mining, and then you get into a quote-unquote oversupply situation or a decreased demand situation, or both, which is basically where we've been in some commodities because of several reasons, which I won't go into. I mean, briefly, you can look at China's situation and others. And so now you're in a situation where they start to fall off. In other words, the marginal producers, as you said, cannot produce at a profit, and they start to drop out, which again causes the cycle to start all over again, because you get in an undersupply, and the demand may even be lower, but the demand is not being met by the people that are still producing at a profit or marginally in the market still. So it's a very precarious situation. It's something that I've grown accustomed to since this is the second major cycle that I've lived through. It's not fun. It certainly does, if you analyze it properly, spell lots of opportunity, because now we are in a situation, unlike the 70s, where the demand for silver and gold, of course, and all the precious metals, platinum, palladium for that matter, are in extremely strong demand because of a world financial crisis. In the 70s, it was basically a dollar problem, which of course is a world problem, as we know, but you didn't have the internet, you didn't have the accessibility to purchase metals in other countries that you have today. You didn't really have all the minting facilities that you have today. I mean, you didn't really have the Perth Mint, the Austrian Mint, all the mints that are available, and the ease that people can purchase physical. You didn't have these funds that are available today. So there's a huge, huge demand that's sitting there potentially to add on to one reason, and that is safe haven status that exists and has existed, that will continue to grow, and it could ignite literally overnight to a demand situation that cannot be met by the marketplace. And I still hold to those words, as crazy as it may sound now, with a 4-year bear market within a secular bull cycle. It's certainly been tough on precious metals investors, and I won't make any excuses for that. But the fundamental facts have remained strong the whole time, and continue to degrade, meaning that it increases the demand potential for the precious metals.
Right. Well, and like it should be becoming obvious to everyone that in terms of precious metals, particularly gold and silver, that the markets are manipulated. So we've now had convictions of the major banks in several other areas. So it's not simply conspiracy theory and so on. So it hasn't happened yet in the precious metals, but it's clearly manipulated. And there's a big gap between physical bullion purchases, particularly coins, and then what's happening on the COMEX. Like I remember in April 2013, it was like one morning, $1.5 billion worth of gold gets sold in a matter of minutes. Like, first of all, no trader is ever going to do that because it's going to guarantee you a loss. And secondly, though, what happened is that there was lineups at all the coin shops, and you would think that people were selling, but no, they were buying. So here you got a bear market on the paper markets and a bull market in the physical markets because the physical buyers realized that they were just given a giant gift of a discounted price, and they were all buying, with both hands. And many of the coin dealers ran out of inventory, and that's where we are today. Like the U.S. Mint has ceased production. The Canadian Mint is a bit tight, and we have such a difference where you've got increasing demand when the price is dropping.
Precisely, and we saw it, as you just outlined, we also saw it in the 2008 financial crisis. Gold and silver got hit as well as the major financial markets across the board. And there was this huge gap between the retail silver price and the commercial bar price. And there were a lot that thought that was it. In other words, that that would be the signal that silver and gold would continue on, and they certainly moved strongly up from those lows. However, the arbitrage that some people expected did not take place. In other words, the silver price versus the silver retail price, meaning coins and small bars, 100-ounce bars or less, did fill in, and that 30% premium narrowed to basically the premiums that we'd seen previous to that event. I think it will happen again this time. Silver retail shortage doesn't mean a silver shortage, and that's something that I think I'm obligated to discuss slightly, because people that are unaware of the two markets get the idea that this is it. There's a silver squeeze, and it's going to continue. So hopefully it is, and it will. But until things settle down, we don't know. It's unfortunate that the demand is so strong that it cannot be met by the mints, and it's a disservice to people that they're unable to meet the demand. But this is something that we've experienced in the past, and I think you'll see it again as we progress through this financial conundrum, to put it in polite terms. I think that people need to realize that supply and demand always meet, and if the demand and supply cannot meet, then the price is the arbiter between the two. So in the retail market, if you want to buy a silver round, a silver eagle, a silver maple, you're going to have to pay a higher premium to obtain that coin. And that's what we're seeing right now, as you said, Nick. However, in the commercial bar market or the commercial market, you're still going to pay a certain price for a 1,000-ounce bar that doesn't have that kind of markup. And the problem is that there's so much paper out there. So a lot of demand that comes into the gold and silver market probably, and this is from a very studied perspective, could not be met if it were always physical demand. However, what happens is that there is demand that's met by a paper contract, and that quote-unquote satisfies the demand. And that's the problem. People say, well, how can you have this type of demand and have it be met by the physical market? And the real answer is it's not. But the problem is, again, that these bank-to-bank transfers, some hedge funds, and on, use a paper proxy or paper paradigm rather than a physical reality. And that's why funds like BMG and others are so important, because they do not play these paper games and you know what you're actually getting, whereas in a lot of other instances you really do not.
Right. Well, exactly. We've got two markets. Is the laws of supply and demand don't seem to apply to the paper markets because you've got, you know, unlimited naked shorting possible. Imagine what would happen in the equity markets if you were allowed unlimited naked shorting, which is illegal, but it's not illegal in the commodities markets, and that's where you get these positions where, you know, 1.5 billion worth of gold is sold in a morning when the entity doing the selling has no gold. So this is ridiculous. The second area, apart from the COMEX markets, are the ETFs. And the ETFs, although they purport to have gold and so on, that gold is borrowed by the authorized participants. So that's when you see an increase in the gold holdings in the ETFs that has no effect on the price or the market supply or demand fundamentals, whether it's being redeemed or purchased, because it's not coming in or out of the markets. It's not an open-end fund where the ETF manager is buying or selling the bullion to and from the markets. It's being contributed and redeemed by the authorized participants, which in turn borrow it. So it's again a paper market that doesn't affect the physical supply and demand.
Exactly.
Right now, I guess you've heard what's interesting is J.P. Morgan, which has been, you know, one of the biggest shorters of precious metals throughout the years. It has a batting average of about 1,000. Like they've never lost a nickel on shorting in that, which is a statistical impossibility if it was a natural market. But now they seem to be accumulating silver, and they purportedly now hold 350 million ounces of silver, according to Ted Butler. That's a lot bigger than Warren Buffett bought in 1998, and it had a big distortion of the markets. And it's getting very close to the Hunt brothers in the late 70s. What are your thoughts on the J.P. Morgan? Have they changed their tune and are now going along?
Well, I have several thoughts. One is that the only way to really know is if you're sitting, you know, in J.P. Morgan's warehouses, and even their location doesn't prove ownership. What we do know, and I did this for our members of our premium service, is I went in and, you know, they look over my shoulder. I literally talk to them like I'm talking to you now, Nick, and show them exactly where I get the information. And I don't know what it is today because I didn't do it prior to the interview, but at the time I did it, I believe the number was 55 million ounces is what you could absolutely prove was owned by J.P. Morgan in both the eligible and the registered categories combined. And the eligible category is not really J.P. Morgan's holdings. It's silver that is owned by someone else and has to be signed over to be sold. So in other words, it's vaulted in their facility but not necessarily owned by them. In the registered category, if memory serves, and certainly the idea is more important than exact numbers, but I really want to be clear on this, I think it was around 20 million ounces was in the registered category, which means J.P. Morgan was the registered owner of that silver. So that takes care of, you know, 20 million ounces. But if you want to put all the eligible that's held by outside investors resting in their warehouses into that category, at the time I did this, I think it was a couple months ago, it was roughly 55 million ounces. And it's really not that difficult to obtain. You just go to the CME website and you look up warehouse stocks for silver, and it's in an Excel file. So if you have Excel on your computer, it'll pull it up and you can print it out and you can study it yourself. Now, as far as what's held by J.P. Morgan, quote unquote, in their SLV situation, again, we really don't know if they're the owner or not. Again, you could have silver resting in somebody's warehouse and they're the proprietor of that warehouse. But again, location doesn't prove ownership. I'll give you a quick example. When Warren Buffett bought 129.7 million ounces of fine silver, a great deal of that ended up in London. And back in those early days in the silver market, there was a fund manager at a pretty high level, and CPM Group had reported year after year that the total holdings in Europe at that time, I'm going back over a decade now, was roughly 50 million ounces in total. And this individual had seen a warehouse, and in this London warehouse had seen without a doubt that there was something, I'm going to make up the number, I forget the exact number, but it was 90 million ounces or something. So I immediately said, well, I could be wrong, hung up the phone, got his number, of course, called Jeff Christian and said, Jeff, you know, putting your feet to the fire here, mine have just been put to the fire, and this gentleman just said that there's far more than 50 million ounces sitting in London right now. And Jeff started to chuckle a little bit. He said, well, David, that is Warren Buffett's silver. That is not the LME silver or the LBMA silver. So again, I make my point that just because it's resting in somebody's warehouse doesn't necessarily mean that they're the owner of it. So lastly, Nick, I'll make the point that SRS Rocco's website, which is my friend Steve St. Angelo, did a pretty good analysis on how much JP Morgan actually owns. I had referenced people to go ahead and study that article. Fact is, I don't know. Ted Butler doesn't know. JP Morgan, the way they keep their books, they probably don't know. But I doubt it's anywhere close to that physical amount. Paper? Well, sure, they could own 350 million ounces on paper. They could own 700 million ounces on paper. In fact, why not 1 trillion ounces on paper? It's all down here on paper, Nick. But as far as physical market, no. I doubt anybody holds anything bigger than, let's say, 100 million ounces. You know, the 130 million ounces that Buffett got was 90 million ounces, and it couldn't produce the other 40 million ounces back in those days. So what'd they do? Well, Buffett let them off the hook, and he let them lease it to him. And lease rates in the silver market were about 17% back in those days, something that Buffett loves, getting interest on his investment. And it was a couple of years, if memory serves, at least a year and a half. I forget the exact time frame. But, and eventually the lease rates went down to like, 2% or whatever. And that meant that 40 million ounces of physical supply did make it to Mr. Buffett. And then, of course, once the 130 million ounces ended up in London, guess what happened? The SLV starts.
Right. Well, what are your thoughts now in terms of what the rest of 2015 look like now? There's probably more potential upside in terms of news, in terms of gold with China and Russia, and that should, as the gold price rises, it should bring the silver up because we're at a very low gold to silver ratio at this point in time. So silver is considerably more undervalued than gold is at this point in time. So what are your thoughts on the rest of the year then?
Yeah, at the risk of looking wrong again, because I'll admit that I really thought that this bear trend within the secular bull market would last 2 to 3 years. It's been 4. I'm still bullish for all kinds of reasons, technically and fundamentally. But you're right, Nick. I think gold is the big player. It has been and will continue to be so. Certainly, silver is a smaller market, and the ratio does indicate that you're far better speculating in silver than you are gold from history. I think that we are going to see stronger prices through the last quarter of 2015. I've been pretty strong about that early on in the year. I thought that this bear market would continue probably until fall. And at that time, you would see the market start to gain strength and momentum and carry it on into a higher level by the end of the year. I still hold to that. I think that 2015 will be a transition year. I know I said that incorrectly a year ago, but again, none of us get it right 100% of the time. I think this year for certain will be it, and I think 2016 is going to be a rather strong year for the precious metals. Basically, the financial elite with this financial repression are playing a game that everyone knows is false. You cannot print wealth. You cannot print your way out of this mess. And depreciating the currency and holding interest rates where savers are penalized and only the banks benefit and governments paying off debt benefit is a game that won't last forever. And in fact, the repercussions have started to show way back in 2008, and they continue to manifest every day that goes by. And the people at large, meaning the people on the planet, regardless of nation state or political beliefs, are starting to get it, and they are understanding that things are getting, worse, not better, on a global basis. Certainly there are pockets here and there that look better, and there's always innovation and human ingenuity. I'm not taking that away or trying to discount it, but on an overall perspective, now things are worse, not better, and will continue to do so. And because of that, the pressure into a safe haven status of money that's existed for thousands of years versus a fiat currency that's never gone near that amount of time is getting more and more pressure. So I see the fact that we'll see a run to gold at some point, and once the run to gold starts, silver will certainly follow. Silver could lead, but I think at this point in time, Nick, you're correct. You probably see it in the gold market first.
Right. I think that when you follow the events that are going on, particularly with China, and their move to move away from the U.S. dollar as the world's reserve currency. And when you follow all the moves, they've signed 28, currency swap deals. They've set up a competitor to the BIS with the BRICS Bank. They've set up a fund to fund the other members and so on. But they've been accumulating hand over fist. The issue is that they want to become part of the SDR. Now that meeting, as I understand it, is scheduled for October. And at that point, it's anticipated that they will have to announce what their gold reserves are. Now officially, they're 1,054 tons. But speculation, given how much they've been accumulating and producing over the years, that they're anywhere from 3,000 to 8,000. Now, if they make an announcement that they have 3,000 to 8,000 tons of gold, all the mathematically inclined analysts are going to go through the numbers, and the question's going to be, where did they get the gold? Because whether it's GFMS or CPM, all the supply demand has been accounted, and there is no 3,000 to 8,000 tons missing. If it's missing, the only conclusion that you can draw is that it's being leased into the markets and China bought it, and it came from Western central banks, in which case there's going to be a big problem in the credibility of the Western central banks when this happens. So one way or another, either China's going to get accepted in the SDR, and meaningful gold holdings are going to give it a meaningful percentage of the SDR, or they're going to set up their competing version of the SDR as an alternative to the U.S. dollar. So one way or the other, we're in for some fireworks in about October. If we have a dramatic rise in the gold price because of that, then you're going to have a follow-on, potentially even higher rise in silver because it's so undervalued in terms of the gold-silver ratio.
I agree with everything you've said, and there's been internet talk or chat recently about a new currency being talked about by the BIS and others around that October time frame. Certainly falls into what you just outlined. Secondly, I would suggest that perhaps there's a possibility that China could be let into the SDR without full disclosure. I mean, they could say, look, we've got 1,054 tons, that's it, and everyone winks and nods. But regardless, what you said is totally valid. I think it'd be best for the marketplace to know the truth, obviously. But it remains to be determined, and as you outlined, Nick, and again I agree that either way it goes, you're going to see pressure in the gold market. I thought early meaning I've been in this market over 40 years now, and I thought once it was announced there's no gold in Fort Knox, that the dollar would be doomed, and the gold market would take off to infinity, as a metaphor anyway. And today I'm not too convinced. I mean, there's pretty good evidence that there isn't much gold in Fort Knox, and if any exists, it's probably leased or rehypothecated several times. But yet, the sleepy American and the markets in general seems to kind of just look the other way or ho-hum it. But that doesn't mean they'll look the other way or ho-hum it forever. And as you outlined, this could be the point in time where all of a sudden it's a big wake-up call to the markets, and they do react to that information.
Right. Well, one of the things is that, like China could be let into the SDR with their purported 1,000 tons, but given that they're the second largest economy in the world, they want a meaningful percentage on the SDR. So each country's percentage allocation is a complex formula, but one of the components is the reserves. So if China is satisfied with a low percentage in the SDR, then they're not going to disclose the reserve. But I don't think they are going to be comfortable with a small percentage. So this has a bit of a different view in that if the SDRs, if the agenda is to replace the U.S. dollar regardless of the economic monetary position, how much gold it's got, then that's going to be a serious threat to the hegemony of the U.S. dollar.
Absolutely. I mean, these BRICS countries and others have been escaping the dollar as much as possible for years. That trend was started several years ago, and it continues. And so basically, you've got an alternative banking system with an alternative money transfer system that competes with the SWIFT system. It's rather fragile right now, and it's kind of in its infancy as far as monetary systems and policies go. But nonetheless, it exists, and there are a lot of people that are very favorable to it. I mean, this Asia Infrastructure Investment Bank has got almost the whole globe that's behind it, with the exception of the United States and Japan. So it's very important that there is an alternative to the dollar. And as you said, Nick, and this again, no one knows exactly how this is going to play out, but there is the possibility, as you said, that China just says, no, we really don't want to participate in the SDR. We've got the BRIC system. We've got this alternative transfer modality, and we're going to walk away from it.
That's right.
So this is something that, the markets have not discounted yet, in my view. Certainly the big players are.
Because unless you've been following this, it's hard to put all the pieces together, because the mainstream media doesn't talk about this in any great extent, and if they do, they're only little tidbits of information where you don't get a good idea of what the big picture is of what China is actually doing, overall. And this isn't conspiracy theory. It's a done deal. When Australia signed the currency swap deal, the Australian Prime Minister came on Australian news and said, well, we're going to be reducing our U.S. dollar reserves because we don't need U.S. dollars anymore. And so there's been 28 of those signed.
Right.
So in all cases, this is where the dollar was in the middle of the trade, and now they're no longer there. So it's going to be interesting to follow, but sooner or later there's going to be some kind of change in this kind of overall reserve currency status, and that's where it's going to have a huge impact on gold. When we couple that with two aspects, really. One is, when I wrote the book, the major premise on coming up with $10,000 gold was simply that the price of gold up until 2013 was something like 97% correlated to total U.S. debt. So they just tracked themselves in parallel. In 2013, they diverged. To get back to the same position, you need about $2,000 gold today. And there's no end in sight that the debt in the U.S. is even slowing, let alone contracting. So if you project out in the future, I think they're talking about well over $20 trillion in debt at the end of the Obama administration, and no end in sight. So eventually you're going to go back to that normalization of matching the gold price to the debt. And the debt, of course, is the cash debt, not the real debt, which is like over 120 trillion, I think, in total. So this is now becoming more of a mainstream issue that the U.S. is going the same direction as Greece. Greece is simply the canary in the coal mine. It's the first one to hit the fan. But exactly the same conditions apply in the U.S. on a bigger scale.
Exactly. I don't really have much to add on. I mean, it's a situation that the powers that be pretend it can be solved, and it can't. The tools they have available don't work.
That's
I mean,
right.
if I forget the first one, it's called TARP or something, but QE1, if QE1 worked, you wouldn't need QE2. If QE2 works, you certainly wouldn't need QE3. And this continual financial repression with these low interest rates, a zero interest rate policy that's gone on for like 6 years or so, has really done nothing to stimulate the economy, although all you hear from the mainstream press is, recovery, recovery, recovery. I think there's something here I should point out. It's well known amongst us that follow these markets closely, but by the average man on the street, they don't really get it. And that is that there's basically no correlation today between the financial markets and the physical economy.
Right.
I want to take a step back on that. Because if you go back to the American system, not this crony capitalism, but the true free market capitalism that used to be in existence, or at least closer than what we have today, there was a pretty close correlation between the financial markets and the physical economy. If you build a railroad and you produce goods and ship them across, the transportation index would show increased economic activity. I don't want to give everybody a big lecture, but I'm trying to state the fact is that the mainstream has pounded into the brain of the non-thinking that the financial markets do represent the physical economy, when the reality is that they don't represent each other hardly at all. I'm not talking about a specific company that may show, very good growth and a new innovative product and that type of thing. I'm talking about the economy at large. And because of that divergence, more and more people are waking up, because so much is now just in the quote-unquote financial markets, where these people are pushing paper back and forth, and gambling has become a large speculative casino, and are showing profits on fiction. These things are actual fiction. They are not producing anything other than profits for the people that are sitting there called at the exchange the delta monkeys. They're looking for a change between a delta, a difference between a buy and a sell, and scalping something in between and doing it thousands of times per second, which is high frequency trading, or these type of things. So the whole thing has become a rather very cumbersome, complex system that is very vulnerable, and yet unless you really understand the details, most people are oblivious to it because they hear the Dow Jones is doing great, and because of that they equate that to the physical economy, when in reality it's anything but.
Right. Well, and this kind of probably gets us to our last point, and that's in terms of people's portfolios and so on. The issue that we've always emphasized here at BMG is that in order to have a balanced, diversified portfolio, you need some representation. There's 7 asset classes, and we can leave out collectibles for financial discussion, so there's 6 left: cash, stocks, bonds, commodities, real estate, and precious metals. And most of the portfolios only have 3: cash, stocks, and bonds. And yet they're purported to be balanced and diversified, and they're nothing but. The global economy is such that not only do all stocks go up or down together, all bonds go up or down together, but stocks and bonds have been correlated since 1969. So stocks and bonds go up and down. And most portfolios have little in the way of commodities exposure, little in the way of real estate exposure, and little in the way of precious metals. At some point, something in the order of 150 to 200 trillion of financial assets is going to try and buy into what today is about 1.5 trillion of precious metals. and the current allocations are about 1.5%. So even if they move up to 5%, let alone 10%, there's going to be huge overwhelming demand. And at some point in time, there's going to be an event, whatever the next crisis is going to be, but there will be a next crisis. These are just the norm. And you're going to get many of the institutions, private wealth, the family offices, the private banks start moving into physical bullion. And it's going to be hard to find physical bullion in quantity. Like, you'll always be able to buy a few coins at a premium, but you're not going to be able to buy hundreds of millions at any kind of a premium. And that's where you're going to see the prices of metals skyrocket from some yet to be determined trigger event.
Absolutely agree. I have nothing really to add on to it other than I'll just
Oh,
react.
it's great talking to you, David, because we agree on everything.
Well, pretty much. I mean, I did say a little bit about the China thing. That it's possible there'll be some other alternative. But thank you, Nick. I appreciate the time with you.
Okay, my pleasure. It's always inspiring conversation, David.
Thank you.
Thank you, Nick Barisheff and David Morgan, for your insightful commentary on silver today. We'd like to encourage our audience to learn more about precious metals by visiting BMG at www.bmgbullion.com and home of the Morgan Report, www.silver-investor.com. Send your questions to us on Google+, Facebook, YouTube, or Twitter using hashtag BMGSilver, or email us at info@bmgbullion.com.